This is InvestTalk. Independent thinking, shared success.
Justin Luke calling in regards to Teck Resources Ltd, ticker symbol TECK. Down 12% in the last 5 days, 20% year to date. Thoughts on a long-term hold? Thank you.
All right. Looking at Teck Resources is actually a name we do own for clients, and they did have earnings that were a bit disappointing. Disappointing? There you go. Disappointing. That's the word. And it had a lot to do with one of their largest mines that they had some trouble with. So, it fell on that news. And the big question is, can it bounce back? I think over time it will. But near term, there's obviously some uncertainty around the future of earnings and that major mine. They did have some positive news about some of their other mines. And Luke, Teck is a diversified miner, not just focusing on copper, which was what that mine focused on. So, do you think this is a reason to jump ship? Obviously, we haven't quite yet.
Yeah, we haven't. Excuse me. We haven't jumped ship. And, I think one thing to consider with any of these miners, right, is they're completely tied to the performance of the underlying commodity. And even though there's been some potential catalysts, right, to copper, obviously this is a diversified miner, about 61% of its business in copper, 39% of its business in zinc. And I think one of the reasons why you have a situation such where poor earnings or disappointments associated with one of their big mines can cause price movements like this is because of the amount of leverage, right? It's got about $6.9 billion of debt on a $16 billion market cap company. The interest coverage ratio is about 1.5. But that works on the flip side as well, right? Leverage also amplifies returns on businesses. And so I think you benefit in this name by having that diversity, not fully being tuned to copper, getting different catalysts that can drive this higher. Certainly for us, we're still holding on to this name. We do think it's a good name. But as with any copper industrial metal mining name, more of a medium to long-term hold, as there's not really a big catalyst for industrial demand to pick up in the short term.
Yeah, long-term, copper has a lot of tailwinds of demand, but from quarter to quarter and month to month, that can certainly ebb and flow. But we think this is more of a buying opportunity longer term versus something to jump ship on. All right. Thanks for the call.
Elevate your investment strategy by joining the KPP Premium Newsletter. Subscribe now for expert insights and tips.
Let's go take a live call. James from New York is looking at Lululemon. Do you own it or looking to buy it?
I'm looking to maybe buy it as a trade. Maybe it's oversold, and I was thinking of maybe getting in just as a trade, not necessarily in a long-term position.
Ooh, as a trade, what are you seeing that tells you this might be a short-term bottom?
It seems like it's trying to find a bottom, but it seemed like a sell-off that took place earlier. Kind of dramatic. I don't know if there's a lot more bottom to go or if this might been a bounce in the near term.
Yeah, see, it already tested the low recently. Let's go back to a daily chart. I'm just looking at the chart here. The low recently back in June was right here around 221, and we tried to get a bounce on Friday, didn't really recover that level, and then was down again today about 1.25%. And so to me, there's nothing about this that screams this is going to turn in the short term. If there was a spike in volume, I might buy that. Pun intended, I guess. But I'm not seeing that. It's just the same volume as it's been for the past couple of weeks. And then if I zoom out to a weekly chart, you're really not seeing major support until about 175, and it's at 216 now. So I think there's still more downside there. And then, between 170, 175, that's the area that I think it could get a bounce from. That I could buy, especially if I get in that zone and then you see a spike in volume, that could tell me, okay, there's some short-term capitulation here. There's a reason for this to have a counter trend bounce at the very minimum. But I'm not seeing anything at these levels after it already bounced, right? And it was a weak bounce. Once again, it got down to around the 220 level back on, was it June 23rd? It bounced up to around 250, and it's just been in a steady downtrend since. And so it failed at the 20-day moving average. It's below all the major moving averages. I see zero reason to be buying this for a trade right at the moment. Thanks for the call.
That makes sense. Thank you.
No problem. Yeah, look for that 170, 175 range to potentially play a counter trend bounce. Let's keep things moving and drop in another listener question from 888-99-CHART.
Hi, Justin. Look, I'm calling today about liquefied natural gas and how to invest in this. I'm curious if you guys invest in it and if you look specifically into domestic companies versus international companies. I own a few. I do own Canadian Natural Resources, CNQ, as well as Williams Company, WMB. But I was just curious if something like TGS, which is a Argentinian liquefied natural gas company, does it matter if it's international? Do you think this company is a good way to invest in LNG and kind of diversify my exposure in case of tariffs or prices or whatnot? If you can let me know just a little bit of information on LNG, that would be great. We appreciate it. Appreciate the show. Thank you. Bye.
All right, looking at an LNG name, foreign LNG name out of Argentina. TGS is the symbol. I'm not even going to attempt to pronounce the name, but they do operate within this space, and it looks like they have a good balance sheet. Certainly some good earnings growth last year. It went from 42 cents earnings in 2023 to $2.38 last year, but earnings are supposed to fall 12% this year, back up 5% next year. No dividend yields. Luke, what do you make of this name and this idea?
I'm seeing strong cash flow, seeing improving profitability. Relative strength is still okay, right? It's down 4.95% year to date, but the rest of the industry is down even more than that, right? It's outperforming its industry by about 22.8% this year. It is the largest, I believe, of the natural gas transporters. They have about 9,000 kilometers of pipeline. They transport about 60% of Argentina's natural gas. And so it is a critical company in a critical industry in a country that has for, I don't know, decades struggled economically, right? And so you would anticipate that even though there's a lot of public sector cuts and a lot of funding cuts and money being cut from budgets in Argentina, that a critical industry and company like this would be spared and would in fact still have a lot of strong government support. It's had decent earnings, I would say, in the past couple quarters. It looks good. They've been expanding. I just kind of worry about the fragile nature of the Argentinian economy. Yeah. But I do wonder, maybe you can give a little bit more take while I take a look at this. See where their revenue's coming from.
Yeah, like anything in South America, you have elevated political risk.
Yeah.
And so that's why this does look pretty cheap. I like diversity. I like getting that foreign exposure, especially in South America, where I do think the political risk is a bit overblown. And I think there's good risk versus reward. Not to say that there's not risk. It's just the valuations you're getting are super attractive in a lot of these South American names, especially compared to our domestic companies where there's so much money and capital has flown into. And so I like the idea of natural gas is needed throughout the world. It's kind of become the swing molecule. It's even more important now than oil in many respects. And so the fact that places like Japan, even China, lots of Europe is really dependent on natural gas, especially with Russia being cut off from exporting a lot of their natural gas, especially to Europe. So I like this name. I like the diversity. I like the valuation and profitability, and the technicals look pretty fine. So what
if I told you that 76% of its revenue is from selling inside the country? That's what I'm concerned with.
Okay, so you're domestic, yeah.
Yeah, they're not really getting a lot of exports. That's kind of the thing that I was concerned about with a company such as this, is now you're relying on the health of the Argentinian economy in isolation, because so much of your revenue is coming from the domestic source. Only 6% from the U.S., 4% from China, everywhere else below 1%.
Well, whatever you think of Milei, the Argentine stock market has certainly improved dramatically since he was elected, and so this is kind of a play on that, is that continuation of recovering of the Argentinian economy. And historically, Argentina was one of the great economies of South America. So I think it still has a lot of potential in that sense. So I'm going to give this one a thumbs up in my book. Let's touch a bit on small caps versus large caps, Luke. And we're in the era of indexing, and historically, small caps had outperformed. It makes sense. If you go talk to one of your, what would you call Eugene Fama? Would that be
a board member?
A board member.
Yeah, a member of the board.
Okay. So he's somebody that you studied and respected throughout the years, and he had what is called the size premium, meaning the smaller the company, over time, you should get better returns. But since 2008, it's kind of been the opposite, right? The bigger the company, the smaller, the bigger the returns, and vice versa. A, do you think this is just simply a product of indexing? And B, do you think there's a time where it might return to small caps suddenly outperforming as they should based on economic principles?
I think you have a problem statistically sometimes when you try and go for narrower time periods versus wider samples.
Sure.
And things that can become really noisy, right? And so how much of the underperformance of small caps relative to mega caps is a result of structural things like flows, right? When people contribute to their 401ks every month or IRAs, what have you, that money is oftentimes just set it and forget it. It's flown into the S&P, the Qs. And yes, it does drag those stocks upward because of it, because there's a lot of demand there. So how much of it is associated with that, and how much of it is associated with an era of zero interest rate unicorn tech stocks that were bid up the wazoo with no profits? Tough to say. That's why you shouldn't really take, in my opinion, small sample sizes in 17, 18 years is a pretty small window compared to the history of markets. And so, if you see this over wider time frames, 20, 30 years, maybe I start to buy that there's evidence of it, but still this seems a little bit too narrow for me to think that the reasons why small caps tend to outperform over time are no longer the case.
Well, I think it's just simply a market structure thing. As you said, so much 401k money and just passive money is flowing into these indexes that are market cap weighted, and active managers tend to invest in smaller names. There tends to be better valuations because there's that size premium. But the size premium now has become so large that those smaller cap names are just better values. And so as money flows from those active names into the passive indices, more money just tends to flow towards those larger names. And I think there's a market distortion that's happening here, that the big question is, when will that reverse? I think it reverses when you go through some sort of reversal of these forced trends, meaning layoffs, really, right? Is when, and also you could also have the boomer generation, who they have a lot of money in these target date funds as well, as they retire and they want to get more conservative, or they just naturally sell off those positions to fund their retirement. I think those could be factors as well. So the big question is, I think, when will this reverse? Because economic gravity is economic gravity. You can't have these market distortions go on forever. And so, I think 17 years is a decent amount of time, but I don't equate it to, small cap investing is suddenly worse. It's just a matter of flows. Flows move prices more than anything, more than sentiment over the long term, right? It's where is money flowing to? We talked about how so much money has flown into domestic equities from foreign markets. Now that's starting to reverse, and that has shifted the dynamics. And so I think it's just underrating how important
flows are to market dynamics.
Yeah, I gotta agree to disagree here. You have measurement bias, and 17 years is not a long time frame for any type of. You just don't get enough sample there, and so you have especially because you have such a unique Fed-driven era that overwhelmingly supported large cap growth, mega cap tech names, that it's just, there's so much noise in there. You can't even really have an isolated understanding of what's going on. There were periods in the past, right, where interest rates were low, where inflation was starting to tick up again. What happened? Small caps underperformed. And so because so much of this time period was from 2009 to 2021, which was a historically weird time to be capitalizing a company, I just think you gotta say, yes, maybe there are some issues with fund flows, but I wouldn't chalk it up to 401ks being the primary driver here and discount the amount of power the Federal Reserve has had going back all the way to the financial crisis.
Yeah, I certainly there's an argument there. I still think the flows are underrated, and I do think that we'll look back in history at some point over the next probably couple decades and say constructing indexes based on market cap is deeply flawed and creates distortions, not just in markets, but also in society, right? Just think of how wealthy the founders of the Mag 7 companies are.
How would you create a benchmark then?
Equate.
Why? But then you would fundamentally overweight tiny names that have zero pricing power, zero revenue, zero profitability. But the index providers, they pick the names. I'm not saying you have to buy every name in the market. Not all of them do. The S&P does by committee, but most index providers do name count approach, right? It's pretty. The S&P is inherently murky, and they just have a bunch of people deciding. Everybody else, the reason why they do it market cap weighted, like Russell, FTSE, MSCI, is because they take the whole investable universe. And they say, okay, well, if this company has 20% of the revenue of the global market, it should probably not be the same size as a company that has 0.00001% of the revenue.
Yeah. Well, I mean, I just think there's a better way to do it. We'll see how I think that evolves. But that's just my take. But interesting topic, and we'll see how small cap investing evolves over time. Now, let's play another InvestTalk caller question now. At 888-99 chart.
I was hoping you guys could take a look at Papa John's Pizza. Ticker is PZZA. I love pizza. I feel like a lot of people do. And from what I could see, it looks like the company makes good money, pays about a 4% dividend, and looks like they have done a good job being able to afford that dividend. And then it looks like it's near some long-term support. So I was looking at it as a potential, if you want to call it a turnaround or just a cyclical play on something that I enjoy. I'll listen on the show. Thanks. Bye.
Well, who doesn't love pizza?
I just made me laugh so much. I love pizza too. He's right.
I guess maybe some people don't like pizza, but most people do. And if you love pizza, well, this is at least the ticker symbol for you, PZZA. And it's Papa John's. Luke, what's your favorite pizza place?
The pizza that I make. No, of the
chains. Yeah.
The chains. I don't know, man. I really think Domino's got a lot better after they changed their crust and did all those things, and you can track it on the website. I think it's good pizza. Papa John's, I think, is number 2 for me, though.
Okay, yeah. I used to like Papa John's back when I ate. Usually, if I buy pizza, I go from support the local businesses type of thing. And I think there's better pizza from locally, so I don't tend to buy from the big chains, but. Papa John's is a pretty good one. We're going to head to a break, though.
Costco pizza.
Definitely that's bang for the buck. Oh, that's for sure. Especially when you're looking at calories.
Oh, yeah.
But we're going to go to a quick break. But after the break, we'll answer this question about Papa John's Pizza. If you have any questions that you want to add to this, give us a call now at 888-99-CHART.
For comprehensive investment resources, visit us at investtalk.com.
Now, before the break, Luke and I were bantering about what our favorite pizza chain was. You're saying Domino's. I'm going to still stick with Papa John's. And that's what we're talking about here. Caller asked about. And they had some controversy some years back. The original Papa left, and Shaq is now, I think, a major spokesperson. And everybody loves Shaq, right?
Again, except for big men from the early 2000s.
Yes, that's very true. But when it comes to their business is not done too hot lately. They're in $3.51 during the pandemic when nobody could go out to eat, and people still needed to eat, and they ordered a lot of pizza. But since then, earnings have come back down to earth. It's supposed to be $1.69 this year, down 28%, but then bounce back next year. I think that's my biggest worry is the recent trend. But is that all priced in? Because this has been in a long downtrend since 2021 when it peaked out around $140 per share. Now we're down to $43 per share. And if I look technically, it had a nice reversal back in May on the charts. And I'm starting to like the look of the longer term chart for potential reversal. But what are you seeing on the fundamental side?
Yeah, on the fundamental side, I mean, cash flow is kind of falling. Profitability has been flat for years coming out of the pandemic. They don't have much debt, and they don't really issue shares. They have 11.96% short interest out there, maybe on the back of this run-up that we've seen over the past 3 months. A lot of people think that that's too much for this pizza company. But one of the reasons why I think they've done well in this turnaround, right, is they have simplified a lot of operations. I think they came up with a loyalty program. But most importantly, they took a page out of the Domino's toolbook, instruction manual, whatever you want to say. And Domino's was really successful from an equity perspective because it became a tech company that sold pizza, right? The pizza order routing, the pizza tracker. Everybody loves a good pizza tracker. And so Papa John's kind of started to do the same thing, leveraging technology to do the most difficult thing it is for a business to do, which is find the customers where they are. And so you have seen some growth internationally. Same store sales up 2% year over year, revenue growth in general up about 1%. Is it enough to change my entire sentiment on a company that's been struggling for a really long time? Probably not, but it is looking pretty cheap right now relative to where it has been. The average forward-looking price to earnings 27, trading about 21 times, trading about 0.7 sales at the moment. But I'm not really seeing a big catalyst for it to really take off back to where it has been, before all these controversies and really before the pandemic.
Yeah, that price to sales ratio around 0.7, that's near the lows that's ever been. So I like that. And their return on invested capital is 24%, which is still a very strong number. Selling pizzas is typically a very profitable business. Their dividend yield of 4%, it's probably isn't going anywhere. It's staying at that level. I don't see a lot of growth. It's kind of pushing up the higher end of what it should pay out. The payout ratio is 77%. So I like it at this point. I think there's a good risk versus reward after this recent reversal. All right, lastly, Luke, let's talk about the EU deal. And the report is that the EU is going to buy $250 billion worth of energy from the United States per year over the next 3 years. Do you think that's possible?
I think that the problem isn't that it's whether or not it's possible. The problem is whether or not the people that negotiated, i.e. The people at the European Union, really have the authority to make those kinds of promises. Right? We talked about at the top of the show, you have to get the member states to agree, and the member states are the ones doing the purchasing. It's not like the European Union is this continental body that is buying energy for the member states themselves, right? And so there's a lot of hurdles here to actually getting something like this done. But as with any administration, oftentimes you really want the headline. Going back to the Japan trade deal about all the investment, only really going to be about 1% of that $550 billion. So the question is, does the headline stick and the reality not really meet the road? And does anybody care? Do markets just keep pumping? But
even if they try, the EU imported about $236 billion of crude last year, about $40 billion in LNG, $50 billion in LNG. And then you had coal as well, metallurgical coal. And so what the end result here, though, is that U.S. exports are barely that much. So we would have to ramp up our production, which we may or may not have as much. And just the numbers don't really line up to where, and even if it happened, it would majorly disrupt the energy markets worldwide. And so it's pretty clear that this is a headline number that won't come to fruition. Maybe we get part of it, which would be obviously helpful. But like you said, to line up all these countries to agree to it, I think is it's a very tough task. And I think that's one of the reasons why the markets didn't really react too much on this news once the market opened. Well, that about does it. I'm Justin Klein with Luke Guerrero. And if today's show made you think about your own financial picture in any way, your investments, your strategy, your taxes, your retirement planning, maybe your downsizing of your home, whatever it is, I encourage you to head over to investtalk.com, click on the portfolio review button, and schedule a no-cost portfolio review with myself or Luke. And we thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.